Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And I've got an interesting video. I hope you'll find it interesting for you today because I'm going to cover a stock that's somewhat controversial, and I've received a lot of controversy about this stock. In fact, it was heavily featured in the news yesterday because the stock price fell approximately 10% at the close yesterday on what I'm going to call is mixed news, and I'll explain that as I go through the video. Of course, the company I'm talking about is IBM. And the question I often get is, why would I ever invest in IBM? Well, I think it's very important, question number one, but I think it's also important that people understand the whole idea behind investing in a company like IBM. Number one, I chose IBM for portfolios that I run that are dividend income portfolios, people that are retired that are looking for maximum current income. And what they're primarily concerned about is the safety of that income and the consistency of the delivery of that income on a growing basis. In other words, they want to see their dividend income increasing and keeping up with inflation, et cetera. Now, the other thing I want to add before I go any further is, this is all about being a long-term investor. All right, I didn't invest in IBM, and I've had it in portfolios now for several years, going back to, I think, 2016. I didn't invest in IBM to make a great deal of money. I invested in IBM with my eyes wide open. I evaluated the cash flows of IBM, both operating cash flows and free cash flows, which I'll share with you in this video, and determined that their dividend was very safe and secure. And I also identified the company as a company in transition. And I also identified the company as a company that I could purchase the fundamentals, especially the cash flows of the business at a very, very attractive valuation, where I was very confident that I could continue to get the income, the above market income, based on both what I could get off of a bond or what I could get off of something like investing in, let's say, the average company or the S&P index company. IBM was offering me a high, stable yield, and it worked very well in a portfolio comprised of 20 to 25 other stocks that I could blend IBM in with to give me some good dividend income. And that's the real key. So let's look at IBM, and let me go through my case of why I still like IBM and why I plan on owning IBM for several years to come. And frankly, why I'm confident that I will actually make money on IBM when all is said and done. I'm already getting the dividend income and the dividend results that I invested in it primarily for in the first place. So let's go ahead and look at IBM via the FastGraphs Fundamentals Analyzer software tool. And what I want you to note here is just some interesting characteristics of the company. Number one is, coming out of the recession of 2001 and in through the recession of 2008, IBM performed beautifully. In fact, it performed beautifully, really, you could argue, all the way up to 2014. The growth of the company was really extraordinary back there. I can actually bring the scroll back to time in there, and IBM was growing at about 10% a year, and it was doing it very, very consistently. I want to make that point, the consistency. Then IBM, the market changed, the cloud came about, and so on and so forth, and IBM then became a company in transition, if you will. All right, and I was aware of that, okay? From a standpoint of earnings, and I'm looking at adjusted operating earnings here, IBM was clearly a company in transition. I didn't expect earnings growth to be very strong. I actually was investing in this company during a period when the earnings had actually been dropping. Now, I will tell you that in 2016, earnings fell more than I thought. They fell by 9%, and I was actually expecting a very modest drop in earnings for 2016. Then, of course, COVID, came along, and we had this 32% drop of earnings that were created in 2020. But I do have a recovery expected for 2021, and that's kind of very interesting, and I'm going to get into some detail on that here in a moment because I think that's very important. But here's the point I want you to note. The earnings have definitely been under pressure. No question about that. That's clear. The white line on this graph is IBM's dividends per share. And you can see the dividends per share have increased, very nicely. Since I've owned the stock, they've gone from just over $4 a share to $5 to $5.50 to $5.90 to $6.21 to $6.43 to $6.51, $6.55 expected this year and $6.86 next year and $7.82. So we've had actual growth of income and we're continuing to expect that dividend to continue growing. This is analogous to why I would invest in a bond, by the way. I don't buy a bond so I can triple or quadruple my money. I always invested in a bond so I could get stable, predictable income, and typically at an above average rate. All right, now if I shorten this graph here, again, to the time that I've actually invested in IBM, and this is approximate, this isn't 100% accurate. My cost base in IBM is around 149. So I just picked a spot here that was about as close to that as I could get, 145.94. All right. But if I look at the time frame since I owned IBM, and again, I'm, skipping a few months here just to be clear, but I want you to get the concept here. When I first invested in IBM, I was getting approximately a 4%-ish yield. Since I've held IBM over these years, that yield has now increased to 4.7%. And again, I expect a dividend increase this year, and I'm probably going to be approaching a 5% yield on cost, or what I call growth yield. As comparing it to the average company, I've got more than twice the amount of dividend income owning IBM than I would have gotten, for example, if I invested in the S&P. What I didn't get was the capital appreciation I could get in the S&P. But again, I was using this as an investment in portfolios that were living off their dividend income. They weren't harvesting shares. They weren't taking profits. They were simply generating income off of their portfolios. And IBM was one of numerous other stocks, 20 to 25, as I said earlier, that were in the portfolio, many of which are growing very nicely. Now, if I calculate my performance on IBM over this time frame, and this is after yesterday's drop of approximately 10%, and I do want to focus you on, what that looks like here. It's a big headline. The market that everyone's talking about it. What IBM did was they came in with their revenue was a little bit short, and I'm going to get into that in more detail in a moment. Their earnings were actually better than consensus estimates were expecting, but they also guided a little bit lower on terms of revenue and earnings. And I'll show you those adjustments here in a moment. But for the time I've owned IBM through yesterday's close after the stock dropped 10%, I've actually got a positive rate of return. Now, I do have a negative capital appreciation. Every $10,000 invested would be worth about $8,800 now, slightly rounded. All right. So I've lost about 12% if I were to liquidate the stock today. All right. But on the other hand, I have picked up, over $2,000 in dividends, as I said earlier. And so I've really got I'm annualizing at 2%, but only if I sold. As far as I'm concerned, I'm getting about a 5% income out of the stock, which is what I talked about, earlier. But I also want to make another point. I fully expect that I will make money on IBM. Based on what consensus estimates are, I could be generating a 6% rate of return by the end of 2023. And I would expect to continue to own IBM to 2023 and well beyond. So I want to make that clear. All right, so let's talk about their recent announcement. By the way, the company just issued a press release, and their stock dropped again 10% after revenues missed, but inline earnings. Okay, I want to clear that. Now, the CEO stressed that Kyndryl spinoff, which they expect to do, I believe, right after the first of the year, will result in a slight pause, according to the CEO, but not a disruption in the business. Okay, they fell by almost 10%. That's absolutely a fact. But prior to the earnings report, analysts were concerned that the spinoff would cause disruptions as long-term contracts got split or renegotiated. Krishna, IBM's chairman and chief executive officer, discouraged analysts from using the word disruption and says that he would characterize the transition as resulting in a slight pause. I think there's a slight pause, and it'll be the end of the third quarter, maybe the beginning of the fourth quarter, and we see that pause mostly in hardware and in Kyndryl itself. I am completely confident that this will be well behind us by the beginning of 2022. Now, what that resulted in, Kyndryl was the area that actually caused the drop of revenues. Okay, IBM saw its sales fall approximately 5% to $6.15 billion as orders continued to drop. Okay, that was in the Kyndryl unit. The unit was set to be spun off as a separate company, as I said, next month. So it could be as early as, I guess, as December. But the point is, that created a slight shortfall in the company's revenues per share. Okay, the company reported quarterly revenue of $17.6 billion, which fell short of the consensus estimate of about 17.81 billion. So, if look at the last fractions, instead of 0.81 billion, they earned 0.62 billion. So they didn't really, it wasn't like they're losing money, bleeding red ink, or going out of business. They also earned $2.52 a share, which, as this Market Watch article was pointing out, was in line, but was actually a penny higher than the 251 that analysts were actually expecting. So, the stock did drop 10%, however. Now, IBM has been aggressively buying back their stocks. I've gone here now to the fast graphs, fundamentals, underlying numbers, or fund graphs, because IBM, during this transitional period, which I showed you, let's go back and look at that before I go on here. Let's look at this transition that IBM has been going through. Again, it kind of started in 2014. Okay, so if I look at fund graphs, starting in around 2014, they really started to aggressively buy back their shares, but they've been buying back their shares all the way going back to 2001. Now, what I want to point out about that is most of that time, their shares have been very, very inexpensive. I like to see companies buying back stock. If a company, a lot of analysts will say, the companies have two ways to reward shareholders, either through dividends or share buybacks. That's what they call shareholder-friendly management teams. Well, it's called financial engineering if the stock price isn't going up while that's going on, and people have a very caustic view. But when everything is going right, they call it, prudent management, shareholder-friendly management. But IBM has been buying back their shares, which means since the time that we've owned IBM personally, in the accounts I mentioned, we've actually had, anti-dilution. In other words, we've actually owned a bigger piece of the pie, if you will, because the share count has fallen on average of about 3.5% a year, during the time we owned it. So what that's meant is that IBM has been able to maintain their operating cash flow per share. When I look at the company from the perspective of operating cash flow, now I want to make a point here. I'm not interested in price when I'm looking at this metric. I'm really interested in how well is the dividend covered by the operating cash flow. Okay, now I can also do that in fund graphs. I can go into the cash flow statement here, and I can look at dividends, and I can look at operating cash flow. And what you clearly see here, just as you did on the fast graph I just showed you, operating cash flow, which is the dark blue line, is significantly covered the light blue or aquamarine shaded area, which is the dividend. But I can also then, the acid test to this to me is also free cash flow. The free cash flow the company's throwing off is also significantly covering the dividend. All right, so I've got that coverage for you here as well. If I look at IBM from a standpoint of free cash flow, once again, I have a great deal of confidence in the dividend being well covered by cash flows, and free cash flows are expected to rise pretty dramatically going forward here, as well as operating cash flow. I have an estimate on operating cash flow, but not free cash flow. So let me go ahead and give you that. They're expected to be growing by 11% and 6% in 2021 and 2022. So I feel very good about that from a standpoint of dividend continues to be well covered, and I do expect them to continue to increase their dividend. Now, they've been increasing it at a lower rate in recent years while they've gone through this transition than they historically have. But there have been periods, because of their prodigious level of cash flow, where they've grown the dividend very quickly. And I think we're going, I expect to see that happen again in the future. More recently, for the last 7 or 8 years, IBM's only been growing their dividend at single-digit 5.5% rates. Longer term, if I look at this, from the longer term point of view, like I showed you here a second ago, IBM's been growing their dividend at double-digit rates. And historically, since, as far back as I can go, they've been growing it at 13 and to 14% rates. So this is a company with a great dividend growth record and a very consistent dividend growth record. And it's what I'm using it for. The company's A- rated. It's a very high quality company, in my opinion. It's got manageable debt. It has taken on some debt, but they've got the cash flows, as I've clearly illustrated here, to pay off that debt. Now, a couple of other things that have happened that I want to bring your attention to is looking at it from an earnings point of view, which is what I believe caused the stock price to drop. The forecast earnings have been slightly dropping here recently. They were $11 a share 6 months ago for 2021. Then they fell to $10.85. Then they fell to $10.79. And now after yesterday's announcement, they've dropped the earnings estimates down to 1040. Looking at the new version, soon to release new version of Fast Graphs, which hasn't updated that yet, because again, this is still a work in progress. It wasn't too long ago we were showing $10.79. So after this recent earnings announcement, it's gone from 1079 to 1040. And that is a drop in earnings. And so I am expecting that, but then analysts are still expecting 10% growth next year and 7% growth thereafter. Now, this is from FactSet analysts. If I check things like Yahoo estimates, we're looking at 1029 and 1145. We've got 1040 and 1142. Okay, so the numbers are a little bit off, but watch this. If you look at the long-term forecast on Yahoo for IBM, they believe IBM is going to grow at 15% a year on average over the long time. The FactSet analysts only expect about 7% growth. So, on that basis, I would still be earning double-digit rates of return on IBM if they were to do that. If I put in, Yahoo's numbers, and I'll just round it at 15%, and look at what IBM could do at 15% growth, I'd be getting 21, 22% annualized rates of return out to 2025 and 6. My point is, this is a long-term hold. The company's covering their dividend beautifully with cash flow and free cash flow. I expect the dividend to continue to increase. I'm using it as an income generator for the portfolios where I'm trying to get at least a 3 to 5% current yield, and I'm mixing that with faster growing companies with lower yields. But I continue to like IBM because I continue to like their cash flows. Now, this is cash flow per share. I want to make sure we understand that. That's part of what doing the share buybacks have done. But keep in mind, we own shares, and our shares haven't changed in the company. And so as the company buy back shares, our percentage ownership, our call on the company's cash flows and earnings is actually increasing as the years go by. And as IBM goes through this transition, and if they eventually are successful, I think we'll do fine. Do I expect to lose all my money in IBM? I think that's about as unlikely as anything I could say. Do I expect to make a great deal of money owning IBM? That possibility, as I've clearly illustrated, certainly exists. But the key is I'm simply harvesting the income here, and the clients that own IBM are spending that income. And they don't have to harvest shares. They've got enough income to cover their needs because their portfolio was constructed with an income focus, not a total return focus, and not a capital gain focus. There are different reasons to make investments. You don't buy bonds to get rich. You buy bonds for safety and security. I don't buy bonds today because rates are so low, so I look for good yielding, high quality investments like IBM that can essentially substitute for what I would normally get in bonds. And I can also get an increasing yield each year to help fight inflation while doing it. So yes, I have no delusions of IBM. I never invested in IBM when I initially invested thinking that I was going to make a great deal of capital appreciation. I own IBM because I believe that income and the dividend is stable, well protected, and has the potential to grow over time. Hope you got something out of this video. Hope you enjoyed it. And if you do, please ring the bell, give me a thumbs up, subscribe to the channel if you haven't. And you also might want to take a look at the Fast Graphs Fundamental Analyzer software tool, because it really does give, a great perspective on investing for you and kind of helps keep you grounded. It's not all about what the stock price is doing, especially in the short run. This has been Chuck Carnevale saying thanks for watching.